Hello and welcome to Two Economists and a Lender, where we take a deep dive into the most important economic issues in agriculture. I'm your host, Billy Grenfell, and today we're excited to talk working capital with economists David Widmar and Brent Gloy from Agricultural Economic Insights. We're also joined this month by Chris Williams, who is a loan officer with Frontier Farm Credit located in Manhattan, Kansas.
Thanks, Billy. It's great to be with you again and talking about working capital this week. And working capital is something that I think I've grown a much greater appreciation for now that I'm farming and actually out in here in the field doing things. I think before it was kind of an academic exercise for me, but working capital is really, as we call it, the original risk management strategy. You know, if we didn't have all the crop insurance and hedging tools and other things that we have available to us today, you know, your only real defense against downward swings is actually working capital in the short term. And if you've ever seen me talk, one of the things I always talk about in the farm sector, going on in the farm sector, I think this chart of working capital, the U.S. farm sector, probably tells a story of what's actually happened in the farm economy better than any other one I can think of. And what we see here is that working capital has plummeted. Back in 2012, we were over $160 billion in the U.S. farm sector. Today, about $60 billion. So that's just a huge, huge decline in working capital. And why it's so important is that this is really the cash available. It's a good measure of the cash available that's still left out there in the farm sector. And we just see it really dry up. And so as we thought about potential topics, we thought addressing kind of working capital, kind of basic, just what is it? But more importantly, how do you manage it and how do you improve your position would be a really important topic. So let's go ahead and think about for a second just what working capital is. And the academic kind of version of this is it's really just current assets minus current liabilities. But that simplicity belies the importance of this measure. And I think what we have to really think about is, as you think about your current assets, what are they? Well, you've got that cash, and that's the most important current asset we have, because it's actually sitting in your bank. You can use it to pay your bills or make loan payments or buy inputs or whatever you want with it. It's really, really important to have a good cash position. But for most farmers, if you're like me, at various times in the year, you've got a huge amount of your working capital tied up in grain inventories or livestock inventories. And it's really important to think about how much of your working capital is tied up in your inventories, and conversely, what would price movements in those grain inventories really do to your working capital position? I think a lot of us kind of leave it sitting out there in the grain bin and don't really think very long about how downward price movements might actually impact our working capital position. Then you've also kind of input supply inventories, whether they be prepaid or actually on your farm. On the liability side, it's kind of things that are due, whether that be payroll or current portions of your long-term debt or other accounts payable. So that's what we're trying to balance here with our working capital position. So that's kind of what it is. But more importantly, this is not just a bean counting exercise. I mean, I think as a professor, we used to always love to write test questions and things about these, but it's more important than that. This is really useful, really important as you go forward. And I think, David, you've thought about maybe some strategies that we can use to think about working capital on your farm.
Yeah, and it's not just Brent and I who think this is important. If we think back to one of our earlier webinars, Jason from South Dakota, we were talking about, I think it was MFP payments, and he mentioned that the billboard that he would put up for producers to think about for 2019 is this might be an opportunity. This year might be an opportunity for a lot of producers to rebuild their working capital, and this would be a good strategy for them to do. So we've outlined sort of three big topics to cover. The first one is finding a working capital measure that works for your operation. The second one is monitoring your working capital trends. And the third point is set a goal. Let's establish a plan to manage working capital in a way that benefits your farm. So the first point, again, is finding a working capital measure that works for your operations. This is where Brent and I's academic background can really sometimes get in the way, because if you think about this, there are a lot of different ways that you can measure working capital. The first graph that Brent showed is total dollars of working capital in the entire U.S. farm economy. You can also measure that for your farm. So how many actual total dollars of working capital do you have? You can also look at working capital as a share of annual revenue. That's another valuable measure. There's also ways of looking at it as working capital as dollars per head of livestock that you have, or dollars per acre that you farm. Finally, there's the current ratio, which is current assets divided by current liabilities. It's a very similar metric. And the point here is there are many ways to measure working capital. Don't get overwhelmed with the nuances of this measure versus that measure. Just step back, think about which one makes more sense for your operation, or the most sense for your operation, and have a conversation with your stakeholders, your financial partners, and talk through this and sort of focus around one that you would want to track and monitor and measure over time.
Yeah, David, I think that's a really important point. You know, it's not about, it's really finding the measure that works for you. And I know you had asked me the other day, well, what do you use in your operation? I said, I like total dollars, because I head into the year, I have a pretty good idea of what kind of working capital position I need to have, so that I have the funds available that I need. We're tracking that pretty closely. In other cases, I know our lender will talk a lot about, you know, a really easy way of thinking about it. What's your dollars per acre that you need to have available? But I think really sometimes I think people start to think about this too much as, well, the lender says I got to have this, but I think more importantly, think about what works in your operation. What level are you comfortable with?
Yeah, personally, I kind of like that dollars per head or dollars per acre, but I grew up on a farming operation that was about 50% row crops and 50% cattle, cow-calf. So that makes it really hard to blend those together to think about working capital as just one of those units. So this is another example of how you have to think about what works best for your operation. The other point that's really important to make here is, Brent mentioned this earlier, is how much risk is associated with your current assets in the form of unpriced grain and unpriced livestock. If we think about commodity price movements, we kind of think about it, but we always think about downside and upside potential, but we never think about the balance sheet implications. And so it's always helpful, maybe you're looking at your working capital as of January 1. It's always helpful to step back and say, okay, how much of this is unpriced grain? How much of this is unpriced livestock? So $1 of working capital that's tied up in maybe a savings account or cash is not the same as $1 working capital tied up in an unpriced grain. So it's really important to think about that as well.
Yeah, I think on your risk management strategy, it's really important to think about how those moves can impact your position, and so you're not caught, surprised that, well, corn prices fell 50 cents, and all of a sudden we're looking around going, well, where are we going to get the funds to pay our bills this summer? So
it's a quick way
to think about that.
Yeah, it's a quick way to burn up working capital, especially in an environment where we're already seeing working capital facing strains. It's sort of another risk in an already difficult farm economy. So the second thought to think through for this webinar is, how has working capital trended over time? The good news is a lot of us have good farm records with respect to the balance sheets. We can pull these balance sheets out and we can start to go back. If we don't already have those metrics written down or tracked and monitored, we can go back in time and pull those old balance sheets out, and we can replicate some of those numbers that we saw in the first graph for your specific operation. Once we see that trend, either maybe it's flat or down or up, it's also interesting to look at the change from year to year. And when we look at changes from year to year, we have two potential measures that come out of that. The first one is the burn rate. how much working capital did you burn in a given year? Then we step back and say, okay, how does that compare to what my total working capital is? If I lost X dollars of working capital, is that 10% of my total working capital? Is it 30 or 40 or 50%? This gets back to what Brent was mentioning earlier. Working capital is the original risk management tool. And so if we think about this burn rate and we think about how much we've burned in the last year or the last 2 years, and we think about how that compares to the total, it gives us an idea about how much more flexibility or risk absorption that we have in the operation. On the other hand, if working capital grows, we can monitor that as well. So how much working capital are we able to gain in a given year? This gives us an idea of what's feasible or reasonable if we have a goal to expand and grow our working capital going into the future. So again, this is just thinking about what's the trend line look like, and then also what's those rates of change to give us an idea of how much risk management we have in that system.
And David, you've been very helpful. I think to me, always encouraging us to kind of sit down and look at how that's trended over time. And I think it's really can be pretty insightful when you go back in history and just kind of look at, well, what was our position? How did we either improve it or see it deteriorate? It's very, very helpful, I think, as you're thinking about making improvements to your operation. But David, at the end of the day, you know, how do we build it, and how do we use it up?
Right, and so the big one is the economic engine of our operation. It's the profits or the losses. And so one of the big ways that we have a big source of change in our operations, working capital, is if we don't have earnings, if we have losses, then we need to dip into those. Or if we have big profits in a year, we have the potential to increase our working capital situation. The second levels, and we're going to talk with Chris about this a little bit later on, are family living is another way which working capital can be used up. A third way is these non-current, maybe these intermediate assets that we might use those earnings or those working capitals that we have on the balance sheet. We move those further down the balance sheets into different assets. And so we think about maybe cash in the savings account, we move that to buy machinery or farmland. It's still an asset, but it's a different type of asset. It's important to recognize that as it moves down, it's not as easily converted to cash. The one thing to always keep in mind is, as a farm financial manager, there's always going to be this striving to strike the right balance. There's going to be times we want to grow and increase our working capital position. And as we start to do that, it's going to be sort of this tug of war with, like, okay, now we have this capital. That's the temptation to deploy that capital, again, into some equipment or into some farmland will always be there. And so there's sort of this, throughout your career, you're always going to be thinking about ways to build working capital, or what's the best use of this capital. So it's sort of something that you're going to always want to wrestle with and think about from time to time.
And I think, David, one of the key challenges you see a lot of people is trying to avoid income taxes. And so we might make some capital purchases, maybe even fund those with debt, which will maintain our working capital position, but at the same time book all of the expense associated with on the depreciation side, so we don't have any earnings. And we want to convert that inventory or whatever it is to cash at some point. It brings with it a lot of deferred tax liabilities. So I think that's one area that can really be attention. The same way, one of the nice things, you build up a nice pot of working capital, provides you some opportunity to make down payments on farmland and other things, other capital purchases. So I think like you said, there's that tension there. And we just want to keep in mind, we have to balance that kind of generating economic earnings, which usually means paying some taxes.
So, one of the questions, one of the things that always comes up is, how much working capital do I need? How much working capital works for my operation? And the first thing I want to point out is that it's going to be different for every operation. It's going to be different for everybody individually. And so we're just going to lay out some benchmarks. Great conversation to have with your lender is what benchmarks they're looking at and what they're most interested in. So the first one we're going to lay out today is the current ratio. Again, we talked about that earlier. It's those current assets divided by the current liabilities. And the goal here is you have more assets than liabilities, so a number bigger than 1 is always good. And there's sort of a color coding system that we use here. Green means things are going well. Yellow means caution. Red means cause for concern. So the green level that's regularly cited as a healthy level is a current asset, about 150% of the current liabilities. Yellow is between 1 and 1.5 or 100% to 150% of your current liabilities. And then finally, when current assets are less than current liabilities, that's a red scenario, and that's a pause for some caution. Think about working capital relative to gross revenue. Something above 30% is in the green area. Again, we've looked at this in the past during the boom eras of the farm financial economy. Back in 2012, we actually had the sector level working capitals in that green level. Right now, the U.S. farm economy is closer to yellow. We're at 13%. We didn't show that graph, but we know, tracking this number, that the U.S. farm economy has trended lower, about 13% here in the yellow, and then red is when we dip into that 10%. So again, also something to think about when we pick a ratio to follow on our farm. This is another way that benchmarking can also help us think about which ones we want to track and monitor on our farm as well, because the current ratio and the working capital, the gross revenue, are two metrics that are easily benchmarked across farms throughout sort of a peer group. So the third piece to talk about today is to set a goal and establish a plan for your farm's working capital situation. So the first one is, what's a reasonable level of working capital? We shared those benchmarks earlier, but as I mentioned, you need to think about what it works best for your farm. You sort of need to have a red, green, yellow, or red, yellow, green, red, yellow, green, yellow, red. My colors are confused today. Green, yellow, red levels for your operation, for the measure that you're most interested in. So first off, understand what maybe your lender expectations are. Have a conversation with them about that. Then also think about what are some of the farm-specific needs. So if you own a majority of your land versus cash rent a lot of your land, that could have different implications on what's appropriate working capital level for your operation. Also think about the enterprises you have in your farm. Maybe irrigated crops versus livestock versus dry land. That can all focus on there as well. The one that the third point here is personal preferences. Sometimes over, maybe there's two principals in this farm. They could have different personal preferences. It's valuable to understand how those differences might be. It's also worth noting that maybe your personal preferences change over time. I know when I was younger and fresh out of college, I didn't think working capital was that important. But now that I'm getting older and thinking about family and thinking about future plans, working capital is something that I put a whole lot more value on. And finally, also keep in mind upcoming changes to your operation. Maybe you're planning to expand, bring on another generation. That can also impact what your working capital goals are. The second point is, where do you want to be? And when you think about where you want to be, it's important to think about that timeline. Go back to that gain rate that we talked about before, and that can help you think about what's a reasonable time frame to build up our working capital moving forward. So
right, get that number in your budget of, how much do we want, if we're not in a comfortable position, how much do we want to build this year, and what's that going to take in terms of family living or CapEx deferral or whatever it might be to kind of improve your working capital position. And likewise, if you're in good shape, what are your plans to deploy that?
Right. So to summarize, before we get to the questions that Brent and I have for Chris, working capital is a vital part of your farm's risk management plan. Now, if we could have a slogan for maybe 2019 would be the year of working capital. Where is your farm at? That's really important. It's the first step in understanding working capital. And when you think about where your farm is at, what's the measure that works best for you in your operation? The third point here is, where do you want to be? Think about your farm's needs and your farm's goals, and then you can start to build a roadmap for improving working capital moving forward. So at this point, we have a few questions for Chris. Of course, if you have additional questions, you can submit those through the question portal, and we'll get to those in the later in the show or in the overtime. So Chris, first off, thank you for joining us. Appreciate you coming on and sharing your expertise. And we started off by talking about a lot of different ways of measuring and tracking a farm's working capital, maybe it's total dollars with a share of revenue. Which do you find to be the most useful and most helpful as you work with operations and producers?
Well, thanks, guys. Glad to be here. You know, when you ask that question, I think it's really kind of two of them, in my view, and use is a little similar, and the reason to use it is similar, and that's kind of that the percent of gross revenue, or this dollar per acre per head concept. And the reason that is you know, it takes some of the size and scope of the operation and kind of matches it up. You know, when you're talking, okay, a percent of gross revenue, you know, most producers in their mind are going to go, okay, I kind of have an idea. I think, Brent, you probably use a little bit of that, you know, with your dollar amount. It's probably, you know, that factor. The thing I like about a dollar per head or acre approach too is when I discuss that with a producer, and we can automatically take that to the production level of, you know, here's my input cost, here's my revenue per acre, and I can formulate that, and you know, and even if it's that combination of acres and cattle, I farm this many acres and I need, you know, is it $200 an acre? Working capital is kind of my target. Plus I have these cows over here, so I want to formulate in $100 per cow. But, you know, really using that feeder cattle market, you know, kind of as one that really works well. You know, if someone comes in and, you know, and I'll use a number of, well, $250 per head of feeder cattle that you're going to go buy, you know, and that way they can kind of formulate that. Now, obviously, you think about feeder cattle, you know, that can be a moving target too, as, you know, a few years back when, you know, you were buying feeder cattle for $500 a head, you know, that number's a lot different than today's, you know, so it still moves with the market, and, you know, and there's a good example of why is that so important to have the working capital there. You know, a couple of years ago, you know, it was an 18-month period that, you know, we lost all that and more in feeding cattle. So, you know, those things are real and they can happen fast.
That's very helpful. I think it's, you know, as we mentioned, some of these bigger numbers, this aggregate number, total dollars or dollars per revenue, sometimes help us benchmark and maybe figure out where we are in the grand scheme of things. But as you pointed out, Chris, this dollars per head or dollars per acre is a very tactical measure that we can think about and execute on as a farm tries to grow that over time.
Yeah, and I think, David, you said it in one of your earlier slides. You know, each producer is going to probably have a little bit of a, I like this method better because it works for me. But at the end of the day, you know, the real numbers are still there, and the reasons we want working capital don't change just because of how we decide we want to measure it. Trend over time still important.
Yeah, agreed. We talked a little bit about some strategies, but we wanted to get some of your ground truth in here. What are some strategies that a producer can use to improve their working capital position? We talked about profits as being a really important one. So what else is there, Chris, that producers can use?
Yeah, ultimately, you know, everybody wants the ultimate is to say, I'm going to do this all organically. You know, profits go into working capital, and that's the solution. And that long term, that's still the reality. You know, there's other ways that when we came through, and I would argue that maybe in that first chart, as we've seen that working capital over the last 3 or 4 years, the severity of the decline had decreased. But I'd like, you know, I think the potential is that some of these measures for short-term shoring up working capital may be in that chart. I don't know the data, but I kind of wonder. And as I think about some of the things that have been deployed over the last few years, when, hey, how do we shore up some working capital to try to make adjustments on the farm and do those things? First of all, you know, we take a look, hey, can we term out move some of that. Over time, we got some things sitting over there that should be down, termed out, and kind of inject a little working capital just through the balance sheet. Early on, when things were good, we've seen a lot of land on a very aggressive payment schedule. Is there an opportunity to kind of get that principal portion to be a little bit smaller? So, taking a look at that first opportunity is maybe the balance sheet. Can we do something there? Other areas of,
Chris,
go ahead.
Chris, I was just going to say, so that's kind of a restructuring issue of, maybe we've got a whole bunch of long-term assets, and we need some more short-term in cash. We can kind of refinance a little bit to fix that.
You bet. That's kind of the approach there. There's also some producers have made a decision of maybe I'm sitting on some assets that are a little underutilized. Maybe that's not the best time to be long equipment, and if there's something out there that maybe could be sold, okay, that maybe now is the time to do that. That frees up some working capital as well. But those two, obviously those are short term. If adjustments, in profitability over time, that helps you kind of get to a point where maybe there's operational changes you've done. Ultimately, long term, it still has to come through profits to kind of keep that shored up.
That's very insightful. And as you mentioned, as you kind of indirectly mentioned, it can be difficult and hard to make some of these improvements. So the first thing is probably to sit down with a trusted advisor, trusted financial advisor, and come up with a specific plan for your operation. So Brent sometimes always challenges me if there's a hard question to invert the question and answer, and maybe the answer is a little bit easier. So if I'm going to invert the question I just asked you, Chris, what are some surefire ways that a producer can get themselves into trouble with working capital? What's the fastest way to get yourself in trouble?
I'll throw 4 quick things I can think of. Capital expenditures out of cash. We kind of talked about that earlier. We're using cash to buy capital assets, and that moves it down the balance sheet real quickly. High family living expense, it's hard to keep track of that always. We do a good job of keeping track of other things because it's going to maybe go on a tax return. So there's an area. That short-term aggressive repayment structure on land. And then ultimately, I think, from the production side and management side, failure to really have a good marketing plan that folds right into your break even and understanding your operation to make a profit.
Yeah,
right.
Really.
At the end of the day, Chris, it's kind of a lot of it comes down to making more than you spend, doesn't it?
Yep, that's true.
So our last question for you, Chris, before we go to overtime is if you could take one piece of advice and put it on a billboard, maybe along I-70 there, south of Manhattan, for thousands of producers to see as they travel across the state, what would that piece of advice be for producers?
Well, I think in today's, conversation, it would really be have a working capital goal, rebuild your working capital to that point before you really go out and try to make capital purchases.
Well, thank you, Chris, for joining us. We invite you to stick around. I think the plan is that you are going to stick around for our follow-up questions, so we appreciate you joining us today. So the first question that I saw coming through here was, do we have a green, yellow, red recommendation based on dollars per acre or dollars per cow? So we didn't include that in this presentation, but what we did include was the working capital as a share of gross revenue. And so it's sometimes easy to convert those kind of back of the envelope in. So I'll give you an example. So if we have 200 bushel expected yield of corn on irrigated corn, and we have a market price of $4 a bushel, that's $800 an acre in projected revenue. And so before we said a green measure for working capital divided by gross revenue was 0.3. So it's 800 times 0.3 would be somewhere around that $240 per acre metric. So it's very similar for cattle. What's your expected revenue on a per head basis multiplied by those various levels, and that'll give you a good way of converting that. So, and it can be challenging. So if you're going to need less working capital if you use this metric for dry land corn than you need for irrigated corn. And so that's why it can be sometimes challenging to use some of these different metrics.
Right. And David, I think too, it's important to, as you point out earlier, going to depend on your situation, what the cash rent situation is, when the cash rent's payable. I mean, that's another strategy people can use. You know, I think we've all gotten into this deal where it's all rent up front. You know, backloading some of that is a working capital strategy to help you manage that. Other rent structures also help. So, yeah, good point. I saw another question in here about family living expenses and working capital. What were you going to say about that? I think our whole point on family living expenses is, you know, at the end of the day, if you want to build working capital, one of your uses of your working capital is usually family living expenses. And so to the extent you can manage those, that will help you build your working capital. So you've got to account for, you know, how much your family living expenses take up of the working capital that you have on the operation. That's what the point I was trying to make.
And Chris,
I don't know if I got that.
We were talking earlier about family living expense and what the true expense is relative to what we might think it is. Did you have anything to add to that, or?
Yeah, you know, I think it's challenging. It's challenging at home. You know, if I look at my own, you know, family living expense and budgets, because it's harder to keep track of. I'm real diligent about tracking anything I can, you know, write off my taxes. Boy, I don't miss those too often. I'm sure I do occasionally, but not very often. And so I have a really good handle around what that is. But it's amazing of how some of those small family living expense things that we kind of maybe aren't, you know, it's not the electric bill, it's not that, you know, those we kind of get a good idea of. It's those other things that kind of bleed off at the end of the year. It's like, wow, that was 10,000. Was that $20,000 more a year? And those are harder to keep your hands around if you're really not diligent about, you know, trying to keep a whole encompassing group of budgets.
Yeah, it's tough. And in terms of what materials are out there to help us better understand that, one is just trying to get a track of what your own family living expenses are. And sometimes it's a little scary to do that, but that doesn't mean we shouldn't do it. The other thing is, I think University of Minnesota in their FinBin program will report some benchmarks on family living expenses. I think Nebraska Farm Business Summary, probably Iowa State has a similar program. So there's some other programs out there. I don't know if Farm Credit Service America also may have some of that information too, where you can kind of at least start to get a track on maybe what, you know, what's reasonable or what other people are doing.
Yeah, well, I think, you know, that's something that we are working on, and as we get more people in our Magnify program, you know, I think that a lot of that data, you know, it's really one of the driving reasons why some of the producers who have signed up for Magnify have certainly wanted that, because that's going to be a valuable tool for them to use.
Yeah, and even I didn't even think of this, and it should have. You know, off-farm income is a good source of that too, that can help pay those bills and improve your working capital position.
Yeah.
So we thank you for joining us today. We hope you enjoyed it, and we hope that you'll join us again next month when we talk about machinery investment. Thank you again to Brent, David, and Chris for joining us today and helping us learn more about working capital. So thank you guys, and have a great day.